much the only thing we're doing is refinancing.
Yeah, rescue capital. Is that fair?
Yeah, we don't like hanging nomenclature to things,
Yeah.
but we call it structured financing. The equity side, we had a lot of what I call tourist dollars, desperate for yield, push forward now to 2024, 2025. The tourist dollars have gone away.
Right.
Everyone's pro forma is just completely smoke and mirrors.
Right.
You went from 5 basis points to 135 basis points. The incomes from these people didn't match the inflationary rate. No one's going to be able to achieve those rents that they had anticipated. Tell me if I'm being too technical.
No, okay, this is perfect.
Okay.
The first part we're talking about cap size stress, right? The cost of capital going 300, 400 bips. Now it sounds like there's a second kind of tidal wave coming, which is a little bit of operational stress. The real healthy way to lower borrowing costs is to follow through with cutting spending. It's tough because the way the political structure is set up, there's no incentive to cut.
Pensum is broken up into 2 operating divisions. On the equity side, we actually own something like 13,000 multifamily units. We're vertically and horizontally integrated. So that gives us tremendous reach in knowledge, expertise, and experience. I came here specifically today because I understand that if I do a good job here, I get to go on Joe Rogan next.
Exactly.
So if I nail it now, I got nothing but upside from
They say it's Joe Rogan first and then
Joe Rogan. Oh,
that's what Felipe says. As you know, he's a
yes.
stand-up comic.
Yeah, he's hilarious to some extent.
Yeah.
So thanks for inviting me.
Of course.
Okay, I know kind of directionally what we want to be speaking about.
Yeah.
As I mentioned to you, I think what might be helpful for the audience is to talk a little bit about where we were, where we are today, the catalyst for how we got there, and then we can talk about the future, both how people who currently have loans need to be thinking about it, and both for acquisitions and for refinancing.
For sure.
So let's turn back the hands of time to 2021, 2022. Look, I don't need to tell you, it was a crazy time in the market, right? It was super prolific. Everyone was doing deals. But what was the catalyst for that, right? And the catalyst was the capital that was available. You had debt and equity, right? Let's talk about each one. On the debt side, you had, at that time, LIBOR, which is today SOFR, which was down at 5 basis points. So you could buy a deal and get, call it 300 basis points, maybe 280 over. And so if you went out and bought a 375 cap rate or a 4 cap rate, you were still in a positive ARB, right? Because 300, 305. And so you were you were still making money. Anytime you can make, call it 100 to 150 basis point spread between your cost of capital and sort of your cap rate, you're talking about mid to high teens returns, maybe even 20.
Yeah, you say cost of capital. It's not just on your cost of borrowing, but probably even the cost of equity as well.
Now, we'll talk about equity in a second, but 100% right. Yeah, we'll talk about that. But so on the debt side, a lot of people said, okay, I will buy a value add deal. And their pro forma said, okay, I'm going to be able to push rents by X amount. I'm going to put $300 a door in, or, I don't know, it was something simple all the way up to, $30,000 a door. But people started seeing this accretion, and it was really more inflation that was driving that than necessarily the improvements that they were doing. But everyone's pro forma showed the same hockey stick. And so if they bought a 4 cap and said, okay, I'm going to pro forma a 5, 5.5, and I was borrowing at 300, I'm making a 200 basis point spread, their Excel sheet showed 25% returns to their investors.
Yep.
So that was very attractive. That's the debt side. The equity side, we had a lot of what I call tourist dollars. And the tourist dollars came from 2 directions, right? What you had is you had people who were desperate for yield on their capital, right? And you couldn't find it in the market. You couldn't find it in the debt product, but you could find it in real estate.
Yeah.
And so you had literally tourist dollars because we had a lot of European dollars coming into the US because you had negative rates in the banks. So people had to move their money out of Europe into the US. And then you also had a lot of people who were smaller investors who were desperate for opportunity. And so,
For yield.
yeah, desperate for yield. And so what they were looking for is they would strike a check for 25,000, 50,000, and they were eager to put this capital out because they were looking at these pro formas and they would see some of the real numbers because they would see, okay, the rent went from $1,200 to $1,500. And that was very exciting to them. And they could actually start to see that upslope. So you had, as you said, you had great equity, you had super cheap debt, and that was the perfect storm for opportunity. So a lot of people went out and just started buying. Not always experienced people who didn't necessarily have the experience to have lived through a cycle before. And so it was all, happy times.
Yeah.
So that's good. Obviously the big transition was rate, right? And that impacted both the debt side and the equity side. We'll put a pin in the rates for a second because we'll come back to that because I think we need to talk about that sort of separately. And so push forward now to 2024, 2025. Clearly SOFR really ran up and now you're at, I think, like 432, 433. So you went from 5 basis points to 435 basis points.
So,
and that obviously changes the whole market. So if you still had a 300 basis point spread, and tell me if I'm being too technical.
no, okay, this is perfect.
Okay.
You like something in the weeds.
Okay. So, if you have a 300 basis point spread to 430, it used to cost you 305, even if you had a minimum base of 3.25. And now you're talking about something in the mid sevens. So how do you buy?
That's capital debt.
Yeah, on your debt. So how do you buy a 4 cap, a 5 cap, a 6 cap, even a 7 cap?
Yeah, no matter what the upset was, weren't solving to a yield on cost that was going to justify any sort of situation where the cost of capital is growing 300, 400 bips during the whole.
Yeah. Not possible. Not
Right.
possible. And so even if you had a value add, it was exciting on an Excel sheet, but it wasn't coming to fruition.
Right.
And so I think what happened is a lot of these inflationary trends that you saw in rents all of a sudden came to a screeching halt. So again, those people who were paying 12, 1,300, no longer could they afford to pay 16, 1,700. That gravy train ended because there's only so much, right? You have inflation in rents, but the incomes from these people didn't match the inflationary rate.
Right.
And so these people went home and they said, well, my discretionary dollars don't allow me to both go to the grocery store and pay these crazy increases in rent. So I have to decide which one's more important. As a real estate owner, potentially even developer, what happened was you had this unbelievable amount of real estate that was delivered during this time. And so you'll have pockets like Phoenix and Nashville that had thousands upon thousands of units that all came at one time.
They're also using yesterday's costs, like future rents. It made sense to build or buy.
Exactly. So now you have a situation where everyone's pro forma is just completely smoke and mirrors. Right. And no one's going to be able to achieve those rents that they had anticipated. So if you can't achieve those rents, now put yourself into today's mindset. Your occupancy rates aren't where you thought, right? Your rent levels are not where you thought. Your concessions are significantly higher. Your cost for marketing and sales is significantly higher. So your NOI has been eviscerated tremendously. Now, remember, the NOI has a compounding effect. And so you don't have to go that high to really have a benefit, right, to your NOI. You get rid of concessions and move occupancy a little bit. That has a dramatic positive impact to your NOI, but you're not seeing that, and you're not seeing it today. And so a lot of those pro formas are just not happening. So the people who are delivering assets today are concerned that they may not be able to achieve the kind of results that they had hoped for, which means that what they built for, those cap rates, aren't really there. And that means that their cost that they build to is not there, and the debt that they have maturing is significantly higher than what they built to, the yield that they built to. So you have that, and then you have the people who actually own, who are now fighting the same tide, right? And so,
and by this, just to, there's a lot there. So let's back up. The first part, we were talking about cap stack stress, right? The cost of capital going 300, 400 bips. Yeah, it sounds like there's a second kind of tidal wave coming, which is a little bit of operational stress, where you're not just seeing muted rent growth, but you're seeing a little bit of higher concessions to the supply finally coming online. You're seeing delinquency where people are stretched thin to make ends meet, to pay rent. So that's, I guess, the second part of what you were talking about, how NOI growth is also getting muted one way or another on top of the cap stack stress.
Imagine if you're someone who's out of school, you're in your mid-20s, you're just starting your career, and you were paying $1,400 a month for a 1995 asset, which was nice. It had some amenities, but now a quarter of a mile away is a brand new asset that they're giving 3 months free rent. Effectively, you could move in for the equivalent of $1,400 a month. You're up and out, right? Because you don't have that much stuff. And so you can move out, and then you just keep playing that game as these deliveries happen. And then the current sponsor's looking at that and they're saying, okay, you want to move? I'll match that 3 months. Okay. So now everyone is suffering because whether or not you bought a 1990 vintage asset and you put all that value add into it, or you delivered a brand new asset, now you have the same issue. So now it's a really compounding effect on sponsors, whether it's a new delivery or whether it's an older asset, or whether it's an older asset that's been value add. So it's very difficult for people to justify a new acquisition today, unless you have a very, very specific plan for a very unique asset. And I think that's exactly what's happening in the market today. And we'll talk about this in a little bit, but the majority of what we did at Pensum, and I guess we should have started with what we do, but I'll do that. We'll do that at the end. We'll do that at the end in case, if people are still paying attention by the end. But when in 2001, 2022, we did almost everything was acquisitions. Right. It was people who wanted higher leverage solutions, that 75, 80, 85% LTV last dollar, which is what we focus on. And we were busier than a beaver.
And I would add to that, we've talked to you guys many times, and one of the strategies we were doing pre-rate hike was underpaying for the real estate in order to, by assuming the debt that was not accretive, right? Because on paper, it looked like a high rate and low leverage. And we'd come to you guys to kind of juice the returns to match where returns expectations are, but at a lower basis. And so that was like a few strategies that we were looking at. I think a lot of if we're kind of looking at it that way as well.
Yeah, 100%. We'll talk about how the different structures and strategies work in a minute. But so we were very, very busy on the acquisition front. Now, pretty much the only thing we're doing is refinancing.
Rescue capital. Is that fair?
We don't like hanging nomenclature to things because I think people are trying to avoid labels. But we call it structured financing, right? And we're trying to figure out how to be helpful to sponsors to get them through their financing. And again, we'll get to the different ways that we've structured solutions for people. So you can't really justify acquisitions right now. We have to do a lot of refinancing. And so now would be a good point for us to just talk about, and the tourist dollars have gone away.
Right.
So now all of those people who were riding the $25,000 checks, at $50,000 checks, because they can find yield in other places, right? Treasuries are in the mid fours, they touched 5. I mean, if you can get a tax efficient treasury at 430 or 450, right? That's very interesting to you. And then you take no risk whatsoever versus someone who may show you 5.5 cash on cash with some future opportunity to make some low double digit return. So you've seen that go away. Obviously, the European dollars have completely gone away because people are reshoring their dollars. The debt has changed, the equity has changed, and now there's a whole new real estate dynamic that needs to be addressed. So let's talk a little bit about interest rates. We did a ton of research. When I say we, I'm talking about my analysts, right? Because I don't do the computer thing. So we did a lot of work on looking at the last several cycles that have gone through the U.S. And in reverse chronological order, you look at COVID, with the Fed reacted pretty properly, right? They first COVID happened, so the first was like a very small change, right? Decrease, and all of a sudden, like a precipitous rock, they just dropped it to zero, right? It's almost like that when a cartoon character runs off a cliff and then just boom, right to the bottom.
Yeah.
Which at that time was the right move. So you had COVID, boom, right down to zero. Go back to 2008, the Great Recession, same thing. A little move, and then boom, they dropped it right down to zero. Okay. Turn back the hands of time to 2001 when you had the dot-com explosion. Same thing. Precipitous drop all the way down. And some of them were big. I think one of them was like a 600 basis points change. The smallest one was 275 basis points. But
the COVID, I would say rates were already pretty low.
That's what I'm saying. Yeah. Yes. So we actually have the numbers here. Yeah. So COVID was 225 basis points to get you to effectively zero.
Not that crazy of a drop, but it felt like crazy drop at the time.
Right. Because you were already so low on a percentage basis change. Right. It was pretty dramatic. Right. But this is where the real focus should be. In 1996, which was arguably the last time that the Fed actually engineered a soft landing. You want to take a guess at how much rates went down?
You tell me.
5 basis points.
Right, went down from
it went from 6 to like, I don't know, just over 5.
Yeah,
that's it. And then it plateaued for 1, 2, 3, 4, almost 5 years. So when we talk about what the future can be, you have to make a decision as a savvy real estate owner operator. Am I in a recession right now? And can I really expect rates to drop precipitously, a la dot-com explosion, Great Recession, COVID? Or is it a little bit more like the 96 effect where I'm going to have continued growth and the incentive for the Fed to drop rates, other than political pressure, is not existent? And if that's the case, then the argument for I'm going to hold on as a sponsor till the very end and just see what I can do, because I think it's a fallacy to believe that rates are going to come down precipitously.
And when you say precipitously, I think at this point, it's like if it drops below 3.5 for treasuries, that's like, all right,
I'll share with you a very, very funny anecdote, and we can take it for a grain of salt. Okay, I'm gonna share these numbers. I don't want to point fingers at anybody, but so the Federal Reserve Bank of St. Louis, what they did is they do what's called the Blue Chip Survey. It sounds very ominous, right? The Blue Chip Survey. they took the 50 top professional forecasters and they said, okay, give us your range for the next 12 months of where you think SOFR is going to be. The range is from 3.9 to 4.5%. Okay. And what they did, that's the top 10 average and the bottom 10 average. So 3.9 to 4.5% over the next 12 months.
It's like 4.3 right now.
Right? Now, the kick in the shin is, this is crazy. From 1983 to 2024, do you know what their success rate of getting it right in the band is?
0.
No, it's 40%. 40%. So you have a better chance of flipping a coin than getting it right and getting in this ribbon. So, we take it again with a grain of salt. We look at where we think rates are going to go over the next 12 months, because that's really what drives our business. And we take a step back and say, if I'm not in a recession, and I don't think that rates are dropping 200-300 basis points, because we don't, can they move another 30 basis points, maybe 40 basis points? Maybe. There is there's one person out there who is plugged into the Fed who suggested, I think it was October or November, when rates started creeping again, that you might see 100 basis points decrease in 2025. That's when the 5-year, and I'm sorry, I'm talking more about the 5-year than the 10-year, the 30.
100 basis points decrease on the 5-year.
Right. So
not on the Fed funds rate, like not at.
No, I'm sorry, 100 bip cut. I'll talk about, I'm sorry, I'll talk about the 5-year, but we'll talk about how that got impacted by all this in a second. But so the Fed basically said, this one person at the Fed basically telegraphed that when it was at 450, you might see 100 basis points drop to 3.5. Now, if you've watched the scale, I think it was September. Pretty sure it was either August, September. I think it was September. It hit 347. Now, that was the busiest month for us because savvy real estate people started picking up the phone and dialing for dollars. They said, I'm going to refinance now. And so we had the best Q4 since I've joined the firm in 10 years because, again, a lot of smart people said, it ain't getting better than this.
Yeah, and that's just for perspective. Wasn't that when the 5-year kind of did it too? To like,
no, that's it. Yeah, exactly. And so that's why I'm trying to marry a little bit of the two. So you saw, you saw,
and that was before the Fed actually cut.
Yeah, the
Fed hasn't cut, but they did telegraph, right? And it's getting precedent, and before the election as well.
So that's exactly what you heard. So you had this telegraph of 100 basis points, and then the 5-year reacted to it again, and we'll talk about how they trade differently. The 5-year reacts to it. It drops all the way down to 345, 347, whatever. And then a lot of people jumped in, and those people who didn't, because they said, okay, now it's at 347, now it's going to go down to 247. And then I'm going to be saved because that 4 cap that I bought 3 years ago, I can't even refinance now, but I'll be fine. And they totally missed it. And so we're seeing a lot of people, because now it's the 5 years back up 100 basis points, right? It's 430 something. And so now it's a tough position, right? I mean, there's the world of coulda, woulda, shoulda. But now let's talk a little bit about how SOFR and the treasuries, how they trade individually, right? Because I think it's important to kind of understand that, and in how they interact, then how they don't act together.
Sure. To set the stage, the 5-year and SOFR are pretty much tighter, right?
They're close. They're close, but that's an excellent point because they're not inextricably linked, right? And so it doesn't absolutely say, okay, if this is moving here, this moves here, because and so let's get into it, right? SOFR is set by the Fed, right? Jerome Powell wakes up one morning and says, it should be this. Okay. Now, it dropped 100 basis. He actually moved it 100 basis points in end of Q3, Q4 of last year. We're here. I've heard lots of arguments that the 50 basis points was completely unfounded. I forgot there's a Fed governor from the Midwest. Her name escapes him right now, but she is the first time that they didn't have a unanimous decision on a rate cut. Everyone was unanimous on 25, but she was
Following 25 were unanimous, or you mean?
no, at the 50. Sorry, at the 50. They basically already said, yeah, we're gonna decrease it, but you had one vociferous voice saying 25. Let's not get ahead of our skis, right? Because we missed it on the way down. Let's not miss it on the way up and overdo it.
I remember when the huddling in the office after a meeting, and they announced it.
Yeah. And I'm not sure it's 100% justified,
Right.
but I'm not in that game, right? I don't have a dog in that hunt. So you've seen 100 basis points. Now, remember, we just talked about 1996, where they dropped at 75 basis points, and then it leveled for 3-4 years. So the question we all have to ask ourselves is, again, if we're not in a recession, because I don't think anybody believes that. I think we had like 2.5% growth in the last quarter. And I'm pretty sure everyone feels very excited about the new administration and then how that's potentially going to move the economy stronger going forward. So if that's the case, I don't know that there's that much need to lower rates right now. So I mean that obviously is a decision the Fed will have to make, but it's tough to put that into an actionable thought process. Should we really be lowering rates right now?
Well, I think I heard this from Ray Bialy, who was on Passive, the All-In podcast, and he had a great take how the real healthy way to lower borrowing costs is to follow through with cutting spending, because cutting spending is recessionary technically, but it's also healthy for the deficit we're in, which will lower rates and lower our rate of increase of a deficit. So I think that's kind of the strategy that should happen. We'll see if Doge follows through.
Yeah.
But
Yeah, but it's a process, right? Doge is a process, right? We found 40 billion in the US AID, which is great, but we need to move 1 trillion, right? And so it's going to be a process, and we need to be patient through that process. So just circling back now, again, just talking about how SOFR, which is set the Fed funds rate, right, and the Treasuries trade, right? Most of what we look at in our business is the 5-year and 10-year, right? Because that really drives the fixed rate market, which is Freddie and Fannie. And it used to be that everyone went right into a 10-year, right? You saw a little bit less of that because people again were concerned, saying, well, if the rates come down again, do I really want to be locked into a near 6%? I'm not sure, maybe not, right? So the 10-year right now trades 20 basis points wide of the 5-year, so it's like 450. Now, let's just say your 130 basis point spread to your treasury metric, right? Whether it's the 5-year or 10-year. So again, and
like
you're
when you're borrowing from Freddie or Fannie.
Yeah, exactly. So if you go to Freddie or Fannie today, and again, after a buy down and everything else, you're saying to yourself, okay, I'm at, I don't know, 580 or something like that. That's attractive. You still have a negative ARB to a 5.5 cap, right? You're getting a lot closer if you're buying a 575. You're in the money if you're buying a 6 cap. But it's really more focused on people who are trying to refinance, right? And they said, I've moved the needle. I did my value add. I need to refinance my existing debt stack because it's come due. I had a floater, which is a 3-year term effectively. I need to figure out how to get out of it. So people are looking at the fixed rate market. We I will tell you, people don't always appreciate the nuance of the fact that the 5-year, 10-year, and let's just call it more holistically the treasuries, they trade based on a trader's mentality. Where do I think, again, more holistic pieces of the U.S. economy are going to trade? And I wrote this down because I love the saying. I want to get it right. On treasuries, deficits matter. And so when people look at where we are today, they say, okay, Fed dropped its rate, so the treasuries have to drop. Yes, there's absolutely a link between the two, but when you have a runaway deficit, that gets baked into the treasuries. And why is that? Because we have to finance our deficits somehow. I think this is the first time in history outside of the major wars where the cost of our debt, right, how much we're paying in interest, will exceed our defense budget.
Yeah.
Now that's mind blowing. People just say, oh, it's just okay, so what? It's a big deal. And the 3 largest expenses we have in this country, right? You've got Medicare, Medicaid, Social Security, and military. So if you've already broached military, you're in rarefied arena. And I think we all need to be very concerned about what that means to us, to our children, and how that will impact the country going forward. So the treasuries reflect that. A little bit of a scary anecdote, right? So 30% of all U.S. treasuries outstanding have to be refinanced in 2025.
Wow.
Right. Mind blowing. I don't know why nobody's focused on, right? And here's the other kick in the shed. Our average cost of this debt is 2.9%. Now we refinance in today's environment, that goes up dramatically. Okay. And
400 bits.
right. So now think about this. Every 1% increase in the cost of capital equates to $2.5 trillion. Okay. Where are we getting that money from? So I like to pick up your comment about what Ray Dalio said. And the only way we're going to pick this one is we need to cut somehow. We're going to need to figure out how to move the economy forward. So lots of growth and cost savings is really the only way we're going to be able to do it.
Right. And it's tough because of the way the political structure is set up. There's no incentive to cut.
Yeah.
No incentive for constituents to cut their struggles. So it's not, as a government to be fair, which is, but if we're successful in cutting, it will solve the treasury interest rate issue in order to get, back to our world, buyers and sellers to transact.
Yeah. Again, I'm very loath to talk about politics because I don't go blue or red. I know what's good for a country. And I think if you put everyone in a vacuum and you say, is it good to cut our deficit? I think everyone will say yes. I think if you ask everyone, is it good to grow our economy? Again, taking it out of the political realm, everyone will say yes. So if that's the case, let's figure out how to do it. A few other scary points. The deficit will be 7% of GDP this year. The CBO.
To that point, I think again, what Ray was saying is like we need like 3%.
Yeah,
Yep,
not
not
higher.
high. But
100%. Yeah, at most.
to be helpful.
Right.
Yeah.
The CBO, which is, they're neither Democrat or Republican, right? They basically say the Fed deficit will be higher than total GDP next few years. Okay. So now we have these scary statistics, and we know that we have to constantly use debt to pay down our old debt and to pay the cost of that debt. Okay. So now who's buying that debt that we have to issue? So historically, it's been lots of sovereign wealth funds, right? The largest buyer of it was the Bank of Japan. What's really interesting in the last, and I didn't write these statistics down. I meant to before I got here, but the Bank of Japan was the largest. In the last auction, they came in very light, and they are reducing their holdings. So we need to find new buyers, right? So Japan, they're reshoring their dollars because there's growth available in Japan. And so we need to find new buyers. Well, how do you incentivize new buyers to come to the table? You got to pay them. So are you constantly increasing the cost that you're willing to pay to these investors?
Does that mean like you're borrowing like you're
Exactly. Now,
or to help with the domestic borrowing, we also learn how to yield what's attractive for foreigners to
exactly. Yeah.
our debt.
Right.
That's interesting.
Yeah. And so we're quite a little bit of a quagmire, right? Because we're, yeah, I'm not going to quibble over whether it's 28 billion or 33 billion. People have like one's off balance sheet, one's on balance sheet. It doesn't matter. Whatever it is, it's a enormous number. And so the question that we have to take a seat back and say, does it make sense for us to use more debt, pay our old debt, to pay? I mean, it's like people who say, I'm going to borrow from this credit card in order to pay this credit card. And then I have to get a third credit card to pay the interest on this credit card. Eventually, that merry-go-round stops because the rate becomes too high. And so I think when we talk about where we think the 5-year and 10-year are going, do I think it comes down over the next 12 months? Yeah, I think it comes down marginally, but it ain't going down 100 basis points. And so I think a lot of people just need to bake that into their pie when they're thinking about, okay, as I go through 2025 and I do have a maturity of something, how do I address that? And what can I do to look at my portfolio and do something smart about it?
Yeah. I want to take a second to also address the viewers a bit, as I think some people might say, well, we're getting through the macro for just figuring out our business plan in multifamily real estate, right? But it's so important to think about these things from a macro level, in addition to what we think about geographically, pockets, what we're both focused on, in order to have a comprehensive business plan and a thesis as a North Star for what you're buying. Like, you need to think about these things, take a second, step back from the Excel sheet and say, okay, what do I think? Where's my thesis? And then, attack based on a thesis and a North Star.
And I'll continue with your point to bring it home from the macro. Now I'll bring it to the micro. I think that was a great sequitur. I don't know if you handed me that grapefruit purposely, but I will now nail that grapefruit. Sure. Why all this talk about interest rates? Why does it matter? Okay. I'm going to throw out a few more really interesting and some scary statistics. This is information from TREP. 62% of outstanding floating rate debt is under a 1.25 coverage. Okay. Why is that important? Most senior lenders, when they look to refinance a loan, like Freddie or Fannie, look to make a 125 coverage ratio, debt service coverage, DSCR. So their underwriting is going to mandate that their total loan proceeds has to fit at least that box. There are going to be 100 other boxes that you have to fit, but that's one which is easily identifiable. So if you have a loan as a sponsor and you're not achieving a 125 DSCR, that means that the senior loan proceeds you're going to be getting are lower than your loan proceeds today. That's just simple math.
Yep.
Now throw out another crazy statistic. Just over 30% of all floating rate loans are below a 1.0 DSCR. Now that's a problem.
But not surprised, right?
Oh my God, not surprising, right? Like, and again, to your point, let's talk macro again, right? Where were we 2021 when people were borrowing, 325 basis points cost of capital and buying a 4 cap? It was okay because they had a 75 basis point spread. Now you have the negative ARB. And so,
Yeah, I mean,
almost by definition,
yeah, if those debt funds were uncapped today, uh, debt funds would probably be like, what'd you say, 300 over? Then, yeah, I mean, you could, what is that, like 8%?
yeah, it's 300 over the 430, so it's 730, 735. Yeah, it's a tough place to be. So now you have billions, hundreds of billions of dollars of real estate loans that are out there that can't cover. All right. And so,
And that's where Pensum comes in.
well, yes, it is. I won't make it an ad for me yet, but absolutely, yes, is exactly where Pensam comes in. I'll give my ad at the end, so stay tuned. But what are your options? Okay. So what's really interesting is the number of loans that got done in 2021 and kind of the beginning of 2022. Again, hundreds of billions of dollars. And that all came due in 2024. A lot of just the providers, the debt funds and some of the banks and something, all those loans started coming due in 2024. Anything that was put into a CLO, and this is even more mind-boggling, CLOs are trading great. I haven't quite figured out. There's obviously a play there. I'm sure Ray Dalio has already figured this out, right? Because I'm seeing a little bit of a rain cloud, and the CLOs are seeing a sunny day. So there's some sort of dynamic play going on there, but no one wants to take a black eye in a CLO. And so how do they address that if they know that they have these loans that don't necessarily work, right? Can't get out of them, can't refinance them.
Is the reason, sorry, just to kind of double click on it for me to understand it, is the reason because the CLOs are at a more, an easier cap stack or like more surety cap stack, like an A note, or no?
No, they are at the A note level, 100%.
But it's like their values are down, but it's not that bad compared to what's trading on CLO from an LTV perspective. Is that why it's something like that? That's what I'm trying to understand.
Well, so I will come back in 2 weeks and we will just talk about the CLO market.
Sure,
That's another whole conversation onto itself. But take it for granted today, CLOs are trading well, and there's a bit of a mismatch because not some of the loans, but a good portion of the loans don't necessarily perfectly underwrite to a refinance right now. And some of them may be missing a little bit. Some of them are missing a lot. Some of them, the equity is completely wiped out, and we'll talk about that in a minute. And so people need to take a step back and say, okay, where am I in my ability to refinance this? There's what we call in our shop the shadow market. You've had a lot of these loans that came due in 2024 leading into 2025. And what happened is the senior lenders, without wanting to have a mark to market on their books, are kicking the can down the road. So if you're a sponsor and you didn't qualify for an extension, sometimes they're willing to play ball. right? The senior lenders are saying, look, I can't get blood from a stone. And if this thing's just not working, for me to take back the keys doesn't make any sense because I'm not going to do any better than the guy who's operating it right now anyway. So even though the metrics may not work, whether it's debt service coverage ratio or the debt yield or LTV or whatever it is, people are going to take a step back and say, I got nothing better to do with it. So I'll give them a 1-year option. Got to buy the rate cap. And so there's a little bit of money you have to come out of your pocket, Mr. Sponsor. And some are asking for buy downs, but they also realize that if someone was maybe a syndicator and they don't have access to that capital anymore, first dollars are gone, then they may not be able to get it. And so asking for it, they can ask for it, they may not get it. And so I think there are a lot of senior lenders who are willing to play ball and just to see what happens.
Do you think that's going to continue in 2025 though? I think the sentiment coming out of NMHC is that that's going to probably stop at this point.
So
we'll love to hear your take.
So so I was going to end with that as a point, which is, what do I think of 2025? And I think that 2025 is the year of recognition. And I think at some point during the course of this year, again, all the macro that we've been talking about will come home to roost. And I think a lot of these senior lenders are just going to say, look, can't kick the can anymore. We need some solution here.
I mean, yeah, most lenders did kick the can to 2025 because that was the sentiment, is that things will get better in 25. And I think what we're seeing in 25, not necessarily better or worse, but stability. And so it's like, hey, this is what it is. You got to work with what we have now, which is 4% treasuries, low 40s silver, and make a move.
This is the new paradigm. And you have to live within this paradigm. I can't be exposed anymore. And so pay me down, replenish an escrow. You just have to do something. We can't stay in stasis. And so I think a lot of things are going to start happening in 2025 because the senior lenders are looking at the statistics that we've just talked about, and they're saying, I don't see rates dropping. All right, not enough to move the needle. And if they're not, I need a solution of something. On those deals where you can't get blood from a stone, maybe they'll be more flexible. But if the senior lender feels, I believe, that they're money good, even though the equity is wiped out, I think they're going to start moving on a lot more assets. We've seen that there are 2 or 3 debt funds out there that are very, very actively pursuing loans where they think that they're $1 good. And you know, the sponsors just can't raise more money. And so I think you're going to see more of that in 2025. So we've talked a lot about macro. We've talked a little bit about micro, what that means for us. And so now, what's the solution? Okay, and here I'll give a 30-second plug for Pensum. Okay, now I'll give a 30-second Pensum plug. So I'll give a holistic overview first of what Pensum does, and then I'll drill down to how I think our solutions help sponsors today. So Pensum is broken up into 2 operating divisions. You have an equity arm and a debt arm. On the equity side, we actually own something like 13,000 multifamily units, a lot of value add product. We're vertically and horizontally integrated in the sense that we own an equity interest in a third-party property management firm that runs, I think it's like 120 or 130,000 units in 30 some odd states. So that gives us tremendous reach in knowledge, expertise, and experience. And then we also do a lot of the value add in-house as well. And we're also a Freddie Mac select sponsor on that side. That'll play into the other side in a minute. So that's the equity arm. The firm itself said, well, if we have all this knowledge, expertise, and experience in multifamily, can we leverage that into a broader real estate investment platform? And so what I focus on is what we call the Capital Market Solutions Group. And we provide higher leverage financing solutions to other real estate sponsors. Again, focused exclusively to the multifamily arena. Think about us again, 75, 80, 85% LTV loans. And we provide that at two buckets. The first is pref and mezz behind other senior lenders. And the second is whole loans or stretch seniors. On the pref and mezz side, we're agnostic to who the senior lender is, right? We do a ton of Freddie Mac, ton of Fannie Mae. I think we did 10 agency pref deals last year. I think it was 4 Fannie, 6 Freddie, I think. Commercial bank, debt fund, life company. We've gone behind everybody.
Which is impressive. I mean, talking to other prep providers, it's not easy to get behind agencies. So yeah, yeah.
Well, it's nice because we're at a point where we do so much volume with them that it's pretty much a rubber stamped approval process now, which is great. So anyway, we can write a check as small as 3 million and as large as 100 million. So, and all the money comes off my own balance sheet. So we can be unbelievably flexible and really tailor make a solution for any sponsors, either short-term or long-term needs. How do we play for these sponsors? When we talked earlier about not having the 1.0 or 125 DSCR, that means that when they go out, the sponsor goes out to refinance, they're not getting the same last dollar. And we call that getting back to cash neutral. So someone took a $50 million, let's call it debt fund loan, floating rate piece of paper. It's come due. And they said, geez, I need to get back to the 50 because I can't draw equity anymore from my pool. So what do? I'm only getting a $42 million senior loan. So Pensum will come and give the $8 million shortfall, and we'll do that in a pref piece. And that's a great solution to people because they don't have to take a dollar out of their pocket. They have to believe, and we have to believe in the thesis that over the next 3, 4, 5 years, there will be incremental increase to the NOI so that there will be an opportunity to refinance us. But I do believe there's been a bit of a dip, again, as we talked about, what's going on macro-wise in real estate, right? Whether it's too much deliveries in one area, whether there's too much pressure on rent growth or concessions or something. And I think we're going to start seeing that. I think we've hopefully seen the bottom of that, and hopefully we'll start seeing that flatten and start to accrete a little bit over time. So that's how we bring value to a lot of these sponsors who are sitting there saying, I need a solution. And I don't want to do a capital call, or I'm out raising a new fund, and I don't want the black eye going back to my investors and showing them, hey, we did a lot of these deals, but not really working out. So how do I solve that? I bring in a Pensum.
And I would just add to that. There's always a question of why are sales volumes so down? Obviously, with rates so high, but like, why are sales volumes so down? Why haven't we seen the distress? And I think this is your answer, right? There's so much capital, like a Pensum, that are willing to solve the cap stack distress by coming in to be cash neutral in order to give more runway for the property rather than selling at a loss.
Yeah, 100%. And that's really the value add that we bring to the table. I think it's really important that people understand, and people who have worked with us understand a few things. One, certainty of closure, which is absolutely imperative today. We have never issued a term sheet at Pensum where we haven't closed. So a very short vignette. Someone came to us back in the beginning of November, had a 1031, had to close by the end of the year. We bid it. We were off by 25 basis points. They went with someone else. And we just said, look, for 25 basis points, you're better off going with us. They said, no, we're big boys. They went with the other group. They put their expense deposit in 2 weeks later. Right after Thanksgiving, he called me and said, look, they proverbially went back to committee. And now they're short $5 million in the proceeds they promised, and their rate went up 300 basis points. Can you step in? So we could have stepped in and really ramrodded, but we honored the term sheet that we offered them originally. And now I've got a friend for life.
Yeah.
And so he said, look, you guys came to the table, 4 weeks to close, which was amazing. You did it at the same rate, even though you knew you could have tattooed me. You didn't. We really appreciate that. And he's been a great spokesman for us.
Yeah, I want to stay on this a little bit, because what people overlook when they think private equity, like, it's not just another way of saying that, it's actual partnership, right? You're
100%.
sitting in the
Yeah.
operating structure with that. And so you are creating a joint venture, and you're in this partnership together. And that's where relationships matter. It's not just about the rate, the last dollar. It's about, obviously, certainty of close, but even after close, being with someone that's not adversarial and someone that can work with you, and getting that business plan through the finish line, especially in this era of high interest rate period, where most executions are rescue cap. I won't say rescue capital, but capital restructured.
Right. I'll tell you another short vignette. We had a deal actually very close to here in Miami. It was a 2-year loan intended just for them to get through the end of COVID. And he was one of those guys who tried catching a falling knife, right? Rates, went up, and he's like, no, rate's going to come down. And so we extended for 6 months. Then we extended another 6 months, and we extended another 6 months. At any time, we could have defaulted the guy because he wasn't really paying the way he was supposed to. And we ended up holding the loan for 5 years, and he just repaid us.
This is on the pref side or the credit side?
It was a mezz piece.
It was a mezz
piece, right. And so we worked with the senior lender, and we gave them comfort that Pensum was going to be there, right? A lot of senior lenders like the fact that we are a operator ourselves, and because of that, they view us as a credit enhancement on any trend. And agencies view us as a credit enhancement. Life companies view us as and the debt funds love us. They're like, hey, we borrow from them, and we also leverage on top of that. And so they say, look, if for whatever reason the sponsor doesn't come through, we know Pensum will step in and help fix things. So that's a little bit. I want to talk about one structure we actually just did. We actually did 2 of them in 2024, and I think we're going to see a lot more of them in 2025.
I hope one of them that you talk about is the one that you did with Henry and Ricky.
I will.
Back in our podcast, episode 2. Okay. So, and that's how we connected here in the first place. I would love to hear how the actual deal nearby.
Sure. Yeah. No, I will do it. If it's okay, I'll talk in round numbers because,
Sure, yeah.
and I think it's right, and I think it's important to talk in numbers because it helps set the stage for what the losses and opportunities were.
Sure.
So a very good sponsor went out in 2021 and bought great asset in Orlando, strong pocket, and let's just say he paid $72 million for it. Back then, it underwrote, it worked well, but then you had a flood of deliveries. All right. And then, so as we were talking about the macro effect, right? Rents came down, concessions went up, occupancy levels went down. And so he had a $53 million debt fund loan. The loan came due August last year. In April, May, he went out to the market to try to find a buyer. And the bids he was getting were, call it 57, 58 million. Now, people were taking advantage because everyone knew that the loan had already come due. And so the value was probably higher than that. But the sponsor was sitting there saying, I can't take a $15 million loss and wipe out all my equity, right? One, he himself personally had millions of dollars invested. 2, it would be difficult for him to raise his next fund. And he believed, as did we at Pensum, that if you could kick the can down the road 4 or 5 years, you'd see, again, what we talked about on the macro level, the digestion of all the new deliveries, you'd see a completely different dynamic on the rent side and concession side and the occupancy side. And he'd move the NOI. And again, because it's compounded effect, exponentially changes, the NOI goes up a little bit. Even if he didn't reclaim all 72, he'd reclaim a super majority of that. And so what we did is we gave him that solution to kick the can down the road, and he didn't have to take a dollar out of his pocket.
So you got into cash neutral.
We did better. We actually came to the table, I think it was 56 and change, let's just say 56. So that was enough to pay off the $53 million senior loan. It was enough to give him a few million for CapEx, and then working capital and some payables they had to pay off. Senior lender was thrilled, right? They got paid out. Sponsor's thrilled because he got everything he needed, plus the dollars to do his value add, which was working. And he was getting like $200-300 rent bumps.
And the senior loan, I'm assuming, obviously, a cash like would be lower than what the original loan was, so he's delevered from that.
Well, so we brought him a whole loan, right, at 56 and change. We did the whole stack. So Pensum brought him a whole stack solution, and we said, okay, we're giving you the one-stop shop solution. He was thrilled. He doesn't have to go out and sew together a few things.
So round numbers, how did you cut that up of credit versus prep versus?
Yeah, I'll walk you through that. But so it worked for everybody, right? We liked it because we thought we were in the right LTV. Sponsor loved it because he got his 4 years, kicked the can down the road. Obviously, the current senior gets paid off. He walks away, and everyone was happy. What Pensam did in this scenario is, again, round numbers, we got a $42 million senior loan, and then we wrote a $14 million pref piece on top of that. Beauty of this is the sponsor at any time over the next, let's go 4 years, they can refinance the asset, sell the asset, or take out just our pref piece. He can find a new person, just to take our pref piece down. So he's in a really good position, and he has the control that he wants for his own destiny. We're happy because we ended up, and this is a little bit of a nuance, we liked the asset so much and believe in the business thesis so much that Pensum, and we don't do this on all the deals, but we actually signed on the senior loan. We signed on the senior loan, we signed the carve-outs because it was a Freddie Mac loan. So we brought Freddie Mac to the table. We did a loan that covered the 125. Great loan, locked in a great rate back from September. So Freddie was thrilled. We're in a great place. We took over asset management, and we helped pick the right property manager for the asset. He's now in a position where he's got an amazing property manager. He's got us doing the asset management, so he doesn't have to deal with any of this. And there's a perfect alignment of interest between Pensum and the sponsor,
which is key. I think when you're giving these pref pieces, all about alignment. Making sure that people on the same page doesn't get adversarial once the dollars are in, because again, it's a partnership.
Exactly. You said it best earlier when you said it's a true partnership. And that's exactly the way we view it, right? Because we came together and we're saying our success is your success. And so there's no light in between us. And he gets weekly updates just like we do. He sits on the same calls as us.
Gives his investors some runway too, right? Obviously, they're now subordinate to a new stack, but it's better than the alternative of selling at a loss.
Exactly.
Getting what? So you get runway to make your dollars up.
That's exactly it.
You got your CapEx out to run and why to give yourself a chance.
Right. That's exactly the opportunity. And that's why the sponsor and his investors are so excited. He was so excited about it that he actually personally and a few of his investors actually came back into the deal, pari passu with us. Right. So we're seeing a lot more of those.
We're seeing great market for land. I know you mentioned that as well, but yeah, great market for land.
A lot more of those. We're seeing a lot more deals where the equity is impaired. Sometimes the senior is impaired, but we're trying to work with sponsors and debt holders to see how Pensum can come to the table and come up with a solution that saves the day. So we're seeing a lot more of those, and I think we're going to see again 2025, the year of recognition. I think that's what we're going to be seeing. So that was a very long diatribe. Hopefully you guys were, hopefully everyone's still awake.
No, that was great. I think one thing I'm asking everyone in the interview right now is the outlook of multifamily in general, operationally. I know we dug very deep in the weeds from a cap stack perspective and rates, and viewers love hearing that as well. But I think operationally, as an asset class for multifamily, how do you see the outlook in the next 3 to 5 years?
Pensum takes a very long-term view on multifamily. Think over the last, I don't remember whether it's 75 or 80 years, it's been the best performing asset class. We're going to continue investing in multifamily. Everyone needs shelter. And our strong belief is over the next 70 years, it's still going to continue to be the right asset class. Everyone who put sticks in the ground in 2021, 2022, even places like Nashville or Austin, where it's been currently overbuilt, that will get digested. And once it gets digested, all those sponsors are going to be great. All the debt is going to be great. It's just time, right? Time heals all real estate wounds. And so we are very, very bullish on multifamily. That's why we're willing to go higher in the capital stack now to provide solutions. We're very confident over the next 3, 4, 5 years, things are going to be great.
Yeah. And I think the strategy you guys have today of coming in as that pref structure, which obviously it's you guys' business plan, but you're doing more of that today, getting people cash neutral than you were doing pre-rate life. That is a great way to still be risk adjusted, getting a strong return while staying optimistic about the asset class. So I think it's a good position to be in.
Yeah. Yeah. That's not to say we don't have issues in our own portfolio. Sure. Everybody does. I don't want it to sound like it's all candies and rainbows, but the way we work now with our current sponsors is different, right? We don't hold a hammer over them. Again, we understand, because we have so much knowledge and experience in real estate, what's realistic and what's not.
Yeah.
What can be done, what can't be done. And so if a sponsor comes to us and says, I don't like my current property manager, I don't think they're doing the best job, we will help them. We sit with them. We interview new property managers. We're doing this on an asset in Alabama right now. They're not happy with the property manager. We went out and we found 5 guys for them to interview. We interviewed with them. We have a deal in Las Vegas. Same exact thing, right? Property wasn't optimally operating. And so we sat with them and we said, here are the guys. Let's interview them all together. We did. They picked one person, and that group has done an unbelievable job. And the reason we were able to identify them is because we have loans all over the place, and we look at the metrics of which asset is operating most efficiently and which property management group does the best job.
Get me that talent.
Exactly. Yeah. Exactly. And we can identify that talent because we have that breadth of knowledge.
Yeah. That's what's beautiful also about multifamily. It's people behind the numbers.
Yeah.
Voice the talent, we self-manage as well. And what you see on paper, on the P&Ls, on the rent rolls, on the trade outs, it's all a function of who's on boots at the ground performing the work. Yeah. So taking that extra second to find that talent and put them in the right properties that need it is the recipe for success.
We 100% agree.
Yeah. Right. I would ask, how can listeners get a hold of you and hear more about Pensam? I know everyone's looking for some sort of capital restructuring heading into 2025, how can people get a hold?
Yeah, it's super simple. All you have to do is go into Google, type in Ray Cleeman Pensum. My personal phone and email is it's listed in LinkedIn. You just click contacts, and anytime you go to,
Oh, you get hit up a lot.
I do.
Too.
Sometimes unsavory folk, but that's okay. It comes with the territory.
Right.
But we will also, anytime you just go onto uh, literally any website, our Pensum website, you'll see my name in there. Anytime we send out a flyer, by email and my cell phone number are there. Call. I tell people all the time, just pick up the phone and call, because you never know. We can provide a solution to someone. I mean, the one thing is we tell everyone 100 units or more. We prefer 1985 vintage or newer. We're not doing construction right now, but we did like 6 construction deals last year. So we're a little bit full up on that bucket. Other than that, we want to see things.
Things are always changing too, right? Your criteria, you want from
100%, 100%.
you
Yeah, 100%.
definitely saying to Ray.
Absolutely. Thank you for the opportunity.
Knowledge.
By the way, if you tell that to my wife, she won't believe you. I'm going to make her watch this.
You make her a woman. Stays awake as well.
Right. That'll be good luck. All right. Thank you, everybody. Thank you for listening.